When buying stocks, you always want to buy at the lower value because then you get more shares per dollar. So when stocks are near their 52-week low, that could be a good sign to start buying. Stocks being at a 52-week low aren't always a good sign because that could mean there's a problem with the stock or the company and it's crashing. But when you're looking at a good quality company that you believe in long term, when the stock is near a 52-week low, that could be a good time to start accumulating more of that company. In this video, I'm going to go over 4 stocks that are trading near their 52-week low and that I've been accumulating recently. The first stock we're going to go over is Verizon. As you can see, Verizon is trading near that $32 52-week low. In the last year, Verizon is down over 30%, and in the last month, they're down about 0.5%. But I think in the long term, Verizon is a company that's going to be with us for a long time. It is in the telecommunications space, so it's up there with AT&T and is one of the biggest of their kind. I like companies that pay dividends because even when the stock is down in share price, you're still getting dividend payments. Verizon has a 7% dividend yield and a 50% payout ratio. I like these numbers because the 7% dividend payment is pretty high in terms of the quality dividend stocks, and anything under 60% payout ratio is usually okay for me, so being 50%, I'm fine with that. The 5-year growth rate is just over 2%, which is okay. The dividend growth rate is 18 years, so they've been paying dividends for the last 18 years uninterrupted, which is a very good sign when you're holding something for a long term. I have been contributing to Verizon occasionally for the past couple months. Every now and then I put a little money into it. But if that share price ever goes back to the $32 or potentially under $30 that the 52-week low was at, then I'm going to probably up my contributions a little more and make them a little more consistent. The next stock is Johnson & Johnson. Johnson & Johnson are down over 11% in the last year, but in the last month, they're up about 6% because they are having a bit of a rebound. Their 52-week low was $150, and they're bounced up to $162 now. They're still pretty close to that 52-week low, and I have been buying Johnson & Johnson for the past couple months, but I still think it is a good opportunity to buy Johnson & Johnson. I think these guys are going to be in it for the long run, and I do want to accumulate Johnson & Johnson while they're at a lower share price. Johnson & Johnson are one of the biggest healthcare companies, and their products are in almost every home in America and many other countries. So I think Johnson & Johnson has proven that they're a very solid company. They've also been paying their dividends for over 60 years, which makes them a dividend king and is one of the best titles you can have if you are a dividend stock. Their dividend yield is just under 3%, which is pretty good, and their payout ratio is about 45%, which is under that 60%, so I like to see that. Their 5-year growth rate is just over 6%, which is a good number for me. And like I said, they've had dividend growth for the past 60 years, meaning they've been paying dividends consistently for the last 60 years. I have been contributing to Johnson & Johnson for the past couple of months because they've been around their 52-week low for a while. I do plan on slowing down my contributions because I want to start putting money into other positions in my portfolio. But if Johnson & Johnson's price was to ever go below 50 again, I would definitely consider putting more money into Johnson & Johnson. What if you buy these stocks and they don't recover right away? Well, that is why they're all dividend stocks. I picked them because they're dividend stocks. When stocks pay dividends, even when their share price goes down, they should be paying that dividend, meaning it is easier to hold that position in a loss because you're getting those payments either monthly or quarterly. And as the price goes down, the percentage or yield tends to go up. So even if you have less money in that stock because the price has gone down, your dividend payments will be close to the same, and they will supplement your loss in share price for the next couple years or however long it takes for that price to go up after the potential recession or economic problem our country could be going through soon. The third stock is Target. In the last year, Target's down about 34%, and in the last month, they're down about 0.5%. As you can see, their 52-week low was $137. So they're still hovering around that mark. They're a little bit over, but it's still a good time to start dollar cost averaging into Target. Now we can go over Target's dividend stats. Their dividend yield is about 2.7%, which is good. The annual payout ratio is about 65%, which is a little higher than that 60% I normally like, but I still think Target is a solid company and this would not deter me from buying more. Their 5-year growth rate is very good at over 10%, and they have 57 years of consistent dividend payments, which makes them a dividend king. One of my favorite dividend stats to determine whether a company is a solid one or not. So me personally, I am putting a little money in Target right now. I'm not going to go crazy with it, but if they do go under $150, I will think about upping my contributions a little more. The fourth stock is Realty Income. This is a real estate REIT, and in the last year, they're down about 16%. The last month, they're up about 0.5%. Their 52-week low is about $55, and they're trading around $62 right now. Realty Income is one of the most popular dividend stocks, and they are known for their consistent dividend payments. So I'm going to go over the dividend stats for Realty Income. Their dividend yield is about 4.91%, and the payout ratio is 207%. I know that is way over the 60% I was talking about before, but this is a real estate REIT, which they have different rules with their dividends where they have to pay more in dividends, and that's why real estate REITs are known to have high dividend payments. A 200% payout ratio sounds outrageous, but for a real estate company, that's not crazy, and I do believe they are going to be able to pay their dividends. They have a 5-year growth rate of about 3.78%, which is pretty good, and dividend growth for the last 26 years. So the last 26 years, they've been consistently paying and growing their dividends. I haven't been buying Realty Income for a while. I contributed a lot a couple months ago and then kind of stopped, kind of forgot about it, but this video kind of reminded me to start contributing again. So I'm going to buy some Realty Income. I feel confident buying it as long as it's under $65. But if it goes under $60, then that's definitely a sign to up my contributions a little more. That's all for today's video. If you want to see the method for how I buy these stocks, check out this video. It'll show you the process of dollar cost averaging if you don't already know how to do that. And if not, that's all for today. Peace.